Are bonds still worth it in 2025? Are bonds dead money in 2025? With high-yield savings accounts paying over 4% and everyone chasing the latest crypto or AI stock, bonds might seem like your grandfather's investment. But here's what Wall Street doesn't want you to know. Bonds might actually be having their moment. Stick around because today we're breaking down whether bonds deserve a spot in your 2025 portfolio. Introduction. What's up, everyone? Welcome back to the channel. If you're new here, we talk about real-world investing strategies that actually work. Today we're tackling one of the most important questions for 2025. Are bonds still worth it? The bond market has been through absolute chaos the last few years. Interest rates shot up, bond prices crashed, and many investors got burned. But 2025 is looking different. So before you write off bonds completely, let's dive into what's actually happening right now. Current bond landscape. First, let's talk about where we stand today. As of August 2025, the 10-year Treasury yield is sitting around 4.23%. That's a massive improvement from the near-zero rates we saw just a few years ago. Here's the key insight. Higher yields mean bonds are finally paying you to take risk again. For the first time since January 2023, the Bloomberg U.S. Aggregate Bond Index is actually yielding more than a 3-month Treasury bill. That's huge because it means you're finally getting compensated for taking on credit and duration risk. But here's where it gets interesting. Morgan Stanley and JP Morgan are both saying we might finally be seeing the year of the bond. Why? Because starting yields are one of the best predictors of future bond returns. With current aggregate yields around 4.7%, historical data suggests you could see annualized returns of around 4.7% over the next 5 years. The Federal Reserve has been playing a waiting game, keeping rates between 4.25% and 4.50%. Fed Chair Jerome Powell has signaled they're still committed to that 2% inflation target, but they're being cautious about cutting rates too quickly. Bonds versus alternatives comparison. Now let's get real about your alternatives in 2025. Everyone's talking about high-yield savings accounts, and for good reason. The best ones are paying over 4.4% right now. Banks like Axos are offering 4.46% APY with FDIC insurance. That's pretty attractive. But here's what most people miss. Savings accounts and bonds serve different purposes. High-yield savings accounts are perfect for emergency funds, money you need access to quickly, short-term goals under 2 years, but they have major limitations. Those 4% plus rates, they're not guaranteed. When the Fed starts cutting rates, which many experts expect later in 2025, those savings rates will drop fast. Your 4.4% could become 2% or lower within months. Bonds, on the other hand, lock in your rate. Buy a 5-year Treasury at 4.2% today, and you're guaranteed that return if you hold to maturity. It's the difference between renting your return versus owning it. Let's talk about I-bonds for a second. These inflation-protected savings bonds are currently paying 3.98%, with a fixed rate of 1.10% plus an inflation adjustment. They're great for up to $10,000 per year, but that's your limit. If you have serious money to invest, I-bonds won't cut it. Corporate bonds are where things get interesting. Investment-grade corporate bonds are offering spreads of about 0.82% over treasuries. That's near historic lows, meaning they're expensive. But high-yield bonds? They're still offering around 7% yields, though experts warn the market is priced nearly to perfection. The case for bonds in 2025. So why might bonds actually make sense in 2025? Let me give you 4 compelling reasons. First, interest rate protection. If the Fed starts cutting rates aggressively, bond prices will rise. You're positioned to benefit while savings account rates crater. Second, portfolio diversification. Yes, bonds and stocks have been more correlated recently, but that's because we've been dealing with an inflation shock. As inflation normalizes, bonds should return to their traditional role as a portfolio stabilizer. Third, predictable income. Unlike dividend stocks that can cut payments or savings accounts with variable rates, a bond's coupon payments are contractual. You know exactly what you're getting. Fourth, the math is finally working again. For years, bonds paid almost nothing. Now you can get 4 or 5% yields from investment-grade bonds. That's real money. Here's a reality check, though. Bonds aren't without risks in 2025. The biggest threat? Inflation resurging. If Trump's proposed policies, tariffs, immigration restrictions, push inflation higher, bond prices could get crushed. Some Fed officials are already factoring potential policy changes into their outlook. Duration risk is also real. If you buy long-term bonds and rates keep rising, you'll see paper losses. That's why many experts recommend staying neutral on duration. Not too short, not too long. Who should consider bonds? Let's get specific about who should consider bonds in 2025. You're a good candidate for bonds if you're within 10 years of retirement and need stability. You have a large emergency fund already established. You want predictable income streams. You're looking to diversify beyond stocks and real estate. You can commit to holding for at least 2 to 3 years. Skip bonds if you're under 35 with a long investment timeline. You don't have an emergency fund yet. You need liquidity for major purchases in the next year. You're comfortable with higher risk, higher reward investments. For most people, I'd recommend starting with a simple approach. Put 3 to 6 months of expenses in a high-yield savings account. Then consider allocating 10 to 30% of your long-term portfolio to bonds, depending on your age and risk tolerance. Practical strategies. If you decide bonds make sense for you, here are 3 strategies to consider. Strategy 1, the Treasury ladder. Buy treasuries with different maturity dates. Maybe 1, 2, 3, 4, and 5-year bonds. As each matures, reinvest at current rates. This gives you flexibility and reduces timing risk. Strategy 2, Total Bond Market Index. Buy something like Vanguard's Total Bond Market ETF, BND. You get instant diversification across government and corporate bonds with minimal fees. Strategy 3, the barbell approach. Combine short-term bonds, 1 to 3 years, for safety with longer-term bonds, 7 to 10 years, for higher yields. Skip the middle maturities. Remember, you can buy treasuries directly from treasurydirect.gov with no fees, or use a broker for corporate and municipal bonds. Conclusion. So, are bonds worth it in 2025? The answer isn't a simple yes or no. It depends on your situation. But for the first time in years, bonds are paying meaningful yields again. They're not the exciting investment that's going to make you rich overnight, but they might be exactly what your portfolio needs for stability and income. The key is thinking about bonds as part of a balanced strategy, not an all-or-nothing decision. Use high-yield savings for short-term needs, bonds for medium-term stability, and stocks for long-term growth. What do you think? Are you considering adding bonds to your 2025 strategy? Drop a comment below with your biggest question about bond investing. And if this helped you think differently about bonds, smash that like button and subscribe for more real-world investing content.